New physical gold supply versus accounted for demand. Now, the total new supply, as we just said, is 2845. The total accounted demand, which we'll break down in a minute, is 1480. There's an unaccounted difference of 1,365. That's 48% of the gold is unaccounted for. That's not normal.
Welcome to the Morning Markets and Metals with Vince Lanci, where each morning Vince brings you the financial and precious metals news to get you ready for your day. And now, here's Vince.
Good morning. Today's market rundown, we'll be discussing the gold reset as a process, not an event. We are at a signpost now, two signposts simultaneously. One everyone may know about, and that is the BRICS Summit, which is going on right now. Yesterday, I did an interview a discussion, I should say, with Matt Riley, hosted by Chris Marcus on Arcadia Economics. That'll be available for subscribers here as well. Today, we're going to talk about specifically, there is a difference between how much gold has been mined in the last year and where that gold is. Almost 900 metric tons are missing, for lack of a better word. Let's just say unaccounted for. Before we do that, however, let's take a look at the markets themselves. The dollar is down 1 at 103.94. 10-year yields are 4.19, unchanged offered. They were very bid yesterday, so bonds were weak. The S&P 500 continues its down drive, down 22 handles. The VIX is 19.15, up 77. Gold is up $12 at 27.31, hovering at another new all-time high. Silver is 34.33, up 56 cents, on its way to $35. Knock on wood, as we said, as we hoped would happen once it broke 32.50. Copper is 4.37, up almost 3 cents. The gold-silver ratio is consequently softer. WTI is 71.41, up 77 cents. Natural gas is 2.30, down 4 cents. Bitcoin, dead cat in the water for the moment at 67,394. Ethereum, 26.37, down 28. Platinum, up 19. I'm sorry, palladium, up 20 at 10.75. And platinum, up 11 and change at 10.17. Grains are, drum roll please, wheat is against the bunch. So you got soybeans are unchanged bid, corn is unchanged bid, and wheat is down 5 cents. Okay, there's the front page. Silver tsunami, we may have a long way to go. Gold locked up and silver locked in. That's a story we did yesterday, and then Hartnett's story. We have other stories out too, but those are the ones that are at the top. Before we get into the title piece, I want to acknowledge Ross Norman, he of Metals Daily. He put a piece out yesterday we read on Zero Hedge, but here it is posted on his website. Metals Daily is a very respected and well-known information portal with regards to metals, and it's an offshoot of Sharps Pixley years ago. Sharps Pixley was Ross Norman's brokerage business that was one of the biggest players in the London market and serviced everyone. Anyway, some of the data, most of the data we're getting today is going to come from that. Since March 1st, when the macro discretionary funds and the Shanghai traders became more aggressively, this is the gold chart. March 1st, gold chart. Now, it's not just the price that changed, it's the behavior, it's the activity, it's the options volumes, it's the pricing differential between Shanghai and New York, it's the chronic offload of gold. But that's our start date as determined by Mr. Norman, which I completely concur with. If you're a subscriber, you know that over the past 7 months, I've been saying something changed in March. Actually, something changed in December, on December 3rd. And since then, there's been accumulation by savvy, bigger players. Only on March 1st did it start to come out of the box. And that's when I saw bullion banks get a little bit surprised and squeezed. But that's where we start, and that's the market since then. There will be math today. We're going to look at the new supply that's come online, meaning mine supply and scrap that's been refined, versus the demand that's taken down that supply. And we're going to find that they don't match up. And we're talking about a real asset here. So the chart you're looking at there, if I blow it up, it's not going to get big enough. The data illustrates the proportion of gold supply from different sources. New mine production accounts for 74.7% of the new gold brought on. The rest of it is accounted for by refined scrap. They get some scrap, they pull it out, they re-refine it, and boom, that's another 25%. So a total of 2,845 metric tons since March 1st, as of, I would assume, October 1st. New physical gold supply versus accounted for demand. Now, the total new supply, as we just said, is 2,845. The total accounted demand, which we'll break down in a minute, is 1,480. There's an unaccounted difference of 1,365. That's 48% of the gold is unaccounted for. That's not normal in any way, shape, or form. So the new supply unaccounted for is 1,365 metric tons. Graphic 3. We're going to break down the physical demand components so you can see where they come from. All right, the data shows the contribution of each sector to the total accounted demand. ETF demand, institutional investors, retail investors, exchange-based captive audiences that deal in physical ETFs, they took on 194 metric tons. Central banks, those reporting, account for 136 metric tons. You don't have to report to the IMF. So that's going to be something important going forward. India also announced 420 metric tons being purchased. SGE delivery, Shanghai Gold Exchange delivery, a whopping 730 tons. Now, ostensibly, that gold is for jewelry and for domestic demand. But it's really hard to say where that gold goes, and it's a big number. And I personally think, the sidebar, it's that gold is going not to people's necklaces or to people's IRAs, it's going elsewhere. Now, when you look at other countries in the G7, all of them as satellites around Germany, that's where your usual biggest demand is. The fresh demand since March 1st has been negligible. So the total accounted demand comes out to, as we said, 1,480 metric tons. These graphics will be in the post as well, so you can see them a little bit closer. So the new supply components add up to 1,480 metric tons. Back to our totals now. If you take the total unaccounted gold supply and you break it down and you factor in other potential claims against it, you allow for a smaller number. So here's what I mean. The unaccounted supply measures up against the unaccounted demand, about 48%. But if you allow for every new COMEX potential contract since March 1st to take delivery, which won't happen, but let's assume that it is, okay? You add another 483 metric tons. So adding them up, the accounted for demand is 52%, right? That leaves 48%. The remaining unaccounted supply is 31%, with 16.97% accounted for by the derivative claims. So you have basically what we know, right? That's 1,480 tons. What we think could come out of it, that's the COMEX, 483 tons. And then the supply is 2,845 tons. The difference is 882 tons. So let's go through that again. There are 882 metric tons unaccounted for at minimum since March 1st, 2024. Where did that gold go? There is a minimum of, let me go back to this graphic here. 31%, even allowing for every contract on the COMEX to be delivered. 31% of all the gold mined between March 1st and now is not accounted for. So where did it go? That's what we want to get at. Now, Ross Norman asks that question, and we're going to start with what we believe, and we're going to add some color that he said. So where is the gold? Well, first of all, non-reported central bank or sovereign wealth fund buying, PLA and other military-related buying. That's our opinion. So if you're a central bank and you don't wish to report to the IMF, whether it be G7 or any other central bank, you just don't report it. Now, why they wouldn't report it? Well, that's their business. PLA, People's Liberation Army of China, and other BRICS nations that are on a more authoritarian governance, their military is off balance sheet. So the military must be kept separate from the government. The military buys their own gold. And we know the PLA has been doing that forever. Other entities as well. SAFE in China does that. So that's another candidate. Other military related buying. So there you have it. Sovereign wealth funds, which don't necessarily report, non-reported central bank buying, and PLA. Who is holding it? Which type of entity or which nations? Well, BRICS nations. That's the likely candidate. China, head and shoulders above the rest of the BRICS nations, right? Remember, Saudi Arabia, over the last 2 years, had been found to clandestinely purchase another 160 tons that we got lucky and figured out about because it was unaccounted for within the LBMA math. So it's not impossible. Another category of who's holding it, well-financed speculators, the China Hunt brother, Chengtong, taking delivery. G7 banks seeking to add to their own supply as principal or as agent for a client. JP Morgan may be buying for a government, and it's as an agency, but it's not accounted for as of there yet. Now we go to Ross Norman and what he says. He lists 3 potential, and I'm sure there's others that he's thinking of, but these are for him the most likely reasons. Number 1, this is the order that he lists them, and I would assume the prioritization. Number 1, without being pejorative, right? He doesn't want to stir up too much here, but Shanghai speculative trading. Now, he says, for sure, gold has seen strong derivatives buying on SHFE and likely within the OTC markets. By likely, that means yes, within the OTC markets. Yes, I'll confirm that. Known players have thrown everything but the kitchen sink at other base metals, and the maxim that size matters has never held more true. That's true. Shanghai traders will historically, when they get, like our banks do, but they have a little bit more of an advantage. When they get the go-ahead from their government, because they are centrally controlled, that there's going to be a stimulus or what have you, they have historically been buyers of rebar, copper, iron, aluminum. Like those things ramp up. I've seen it for a decade. There's no reason to think that they're not doing something like that in precious metals. However, we're talking about physical here. We're talking about physical that's being bought. So if you buy it, it's speculative, but you're spending the money. They're taking their risk. We'll come back to that in a second. Launch of a competing currency for BRICS trade. Now, he says, quote, we are in the realm of speculation here, but quite possibly the BRICS nations might backstop a new currency with a partial gold backing. Let's see. Okay. To his credit, that's not speculation. It's conjecture. Speculation means you have no information. It's conjecture. The BRICS Summit is going on right now. We've been discussing M-Trade here for almost 2 years now. And it's been apparent that de-dollarization is not just a rumor. Now, most people in the West aren't aware of that. So to them, it seems like speculation, but there's plenty of empirical evidence to that effect. Whether they pull it off or not is entirely unknown. But launch of a competing currency for BRICS trade, yeah, that's entirely possible. We don't think that's happening, but we think effectively it's happening. The gold is going to be allocated into a basket, and that allocation is going to be used for international trade. and it's not going to go anywhere anymore. It's purposed. So essentially, gold isn't replacing dollars. Gold is replacing treasuries as a store of value with fallout to the dollar. Third one, and this is interesting. Destabilization of the LBMA and U.S. global reserve currency pricing power hegemony. Now I'm quoting him. Many nations envy the central role that London plays in the global bullion market, and they make no secret of it, much like, quote, the exorbitant privilege the U.S. has with the global reserve currency. So is this part of a bigger story with a player wishing to take control of the global gold market? Maybe, but that's going out on a limb. Okay. Comment on that? That is what's happening. And maybe there is envy here. And I'm not contradicting him at all. Again, he's being humble. It's not going out on a limb. That's what's happening. Are they doing it surreptitiously? Possibly. Are they doing it quietly? Possibly, because maybe they don't want to disturb the other side of the table. Maybe the West, they don't want to cause an uproar. But whether they are envious or doing it surreptitiously or not, it's an economic consequence of what's going on in the world. So we think that Ross is spot on. We think all the above are true, but not as nefariously as it appears. Oh, there's some nefariousness going on here. The possible exception being the Shanghai speculators, who are not immune to playing the West game in reverse. But if they are actually buying the gold, then their problem will come when they wish to take profits. Look, if you're buying all that gold and you're driving up the price 34%, speculatively speaking, well, when you sell it to take profits, you're going to drop it by more than 34%. You can't check out of Roach Motels, especially when the West knows that you're long and you need to sell. That's what traders do. So it should take care of itself. Now, granted, there's dislocation involved here, but at least it's gold and not oil. At least it's gold and not nickel, right? There's no dislocation that's permanent because gold is a pet rock, right? Okay, so we'll have much more to say on this from a secular and market structure point of view in a podcast coming out later today that will harken back to a podcast that we did with Tom Luongo on the market structure and how gold is changing as a reflection of the world's economy. Suffice to say for now, what is happening, and I believe that Ross is right on all three counts, this is the necessary byproduct of global economic disparity as measured by financial assets rebalancing themselves against the real assets and collateral that underpin those finances. Remember when Zoltan Pozsar said there's a crisis of collateral coming? Well, this is it. In other words, gold revaluation is happening right now to better reflect new global economic realities already made real since the global financial crisis. To what practical purpose? Well, being a little bit more practical. If the BRICS are the buyers, it's the purposes of de-dollarization as a substitution in their multipolar setup, Enbridge, BRICS Pay, what have you. If China is buying, whether it be with the BRICS or without the BRICS, they're moving from a loose peg to the dollar to a loose peg to gold, as evidenced by increased correlation to Chinese government bonds. Again, that's also been corresponded here. While most of the world was discussing the breakdown in U.S. correlations, T.S. Lombard and ourselves noted the breakdown and looked for correlations elsewhere. And the correlation is extremely well linked with Chinese government bonds right now, which would suggest that they are beginning to ease off of dollars and on to gold. That's our speculation. Now, regards to the specs themselves, who took the rest of that gold, if they take delivery, then it is not a bluff because they took delivery. If they don't, then their gains will be lost on exit. So all those COMEX longs, can you imagine taking 480 metric tons of delivery on gold? It won't happen, but can you imagine that? It wouldn't happen. COMEX would shut down because it would be deemed manipulative, and it would be rightly so. I'm going to add another one to the mix. G7 banks. Europe has openly spoken of gold revaluation. They have an account called the gold revaluation account. It's basically a piggy bank that says if we ever need the money to offset our losses from our bonds, we can just price gold to where it's currently trading. Now, if they did that, that would be a license to buy more gold, and that would explode gold. So they're not going to openly revaluate. At least I don't think they would. Tom and I don't, actually. But Europe has openly spoken of it, and they all want to buy it. Eastern Europe is openly buying and flaunting their purchases publicly. And the G7, if Enbridge is successful, will need more bullion available if they wish to trade with the BRICS internationally. This is what mercantilism is. Okay, you have your dollars. We have our gold. If we're going to buy something from you, we'll need dollars to buy it. If you're going to buy something from us, you'll need gold. And isn't that what Agora is? It's the Western equivalent of Enbridge. Anyway, look, this is to paraphrase Matt Riley. I have been saying for a long time that the wall is going up to keep us in, not to keep them out. But he put it in a Cold War phrase that I thought was very good. He said, the financial Iron Curtain is going up, referring to the initial action that we took against Russia in confiscating their wealth. And that's exactly what's going on. Cuban cigars used to be expensive. Well, what's Russian gold going to be worth? Maybe more, maybe less, who knows, but it will be worth different. So that's it. We're going to do more on this. The charts will be there. Look, there's call it 1,000 tons. There are 1,000 metric tons unaccounted for. Will they be sold eventually? Yeah, they might be sold as the election comes. It could just be completely a spoof. I've seen this before over the years. Buffett, whether he wanted to or not, spoofed the market. Philip Brothers did. Soros did. It's happened all the time. Okay, this is very serious. The BRICS event is significant, and I think this is related to it. More on this later. Let's take a look at the markets right now. Gold is peaking up against this. Look at this from a technical point of view, starting with the daily. Remember, I described the fishhook down here. I said we're probably going to go to. We're not. I hope we go to 27.25. I had longs, and I'm hedged now. Well, we got above it. There's my line. That was my level to exit. And now we're above it. And now I say, okay, we've done this measure and move. Anything from here, I don't really have a guideline. Well, now if you zoom in, this is a fractal market right now. Here's your dip. That's a dip from, call it 27.40 to 27.15, $25. 25.65 is on the table now. And it could happen in the next 48 hours. That's it. Silver also having a little bit of a measured move there, already broken out of its measured move. So silver, call it 33.50 to 34.20, 70 cents. That puts us at $35. I will speculate that silver will trade $35 by Friday. But I don't have a position reflecting that. So opinions are pretty easy. Anyway, I'm Vince. Again, there'll be another podcast on this later on, laying it all out. But there's missing gold. It's unaccounted for. No one is talking about it. The emperor is partially naked. He's disrobing as we speak, and people continue to be blithely ignorant of it and not discuss it in the West. Have a great day.
Well, thanks for watching this morning's Markets and Metals with Vince Lanci. We sure appreciate you tuning in and starting your day with us here. Hope you enjoyed the show, and we'll see you again tomorrow. Please note that this video is not intended as legal licensed financial trading advice and is to be used for informational purposes only. Please contact your financial advisor before making any decisions, and thanks for watching.